Business Morning right here on Channels Television. Let's see what's happening with the commodities. But first, we'll start from the forecast, GDP forecast of IMF for Nigeria in 2026. It was placed at 4.2 before, but has been upwardly reviewed to 4.4%. And I think for Nigeria, Nigeria's expectation is about 5%. I remember the NESG expect 5.5% growth. So we are more optimistic than the IMF. Dumebi is right here. Dumebi Oluwole, welcome to the program. It will be good to have you. So we are always more optimistic, but at the end of the day, we'll know what the reality is.
It's good to be optimistic.
It's good to be optimistic. I think there's another body that expects a 7% growth of the GDP this year. Okay. So which one is FDC seeing?
I think the stance primarily, and I would even say this even for myself, cautious optimism is what is advised.
So is that a 4.4, a 5.5, a 7?
No.
Maybe looked at me with a bad eye right now.
So yeah, so within the range of 4 to 5%, and the reason is because we have seen, growth numbers actually begin to pick up from Q2 2025 up until Q3 2025 rather. We saw growth increase to around approximately 4%. And when you look at some of the changes that we have seen, especially with the GDP rebasing and how that there are additional sectors that we expect to do better, entering into the medium term, that's 2026 up until 2029. Expectation is that growth numbers are likely to remain positive and within this 4 to 5% range. Sectors like agriculture, when you even break it further down, you look at crop production, you look at the fishery sector. We expect some growth on there, and that's likely to support the growth in agriculture. Then you also look at the real estate sector. From the rebasing exercise, so that real estate became, a prominent sector expected to drive growth in the medium term. And we expect that trend to also continue. The industrial sector as well, and that includes manufacturing. With the level of technological adoption that we're seeing, the drive for value addition, and increase in private investment towards that sector, even stemming from the agriculture bit as well, we see that that's expected to support production levels, support productivity, and support output levels. Then there's a lot more nuance as well on the services side, with financial services, telecommunications. Those are prominent sectors that we expect to see continually maintain that positive trend. Insurance as well, to maintain that positive growth trend, and also
I believe insurance because
GDP
of the Naira, the new law, the drive, the recap.
Exactly. So the recapitalization and all of that expected to support that sector. With financial services, we know the fintech bit is going to keep growing and supporting that, but primarily also look at it from the traditional banking sector as well, and how that growth in the financial services sector is expected to support the broader GDP growth. I think one thing to just mention as well will be the informal sector as well. So we expect more formalization to happen
with the new tax law.
With the new tax laws, yes, exactly, and that again would mean a lot more for our productivity levels, because then there's a lot more data to now even work with. But more importantly is with the PMI numbers, private sector numbers, and that's capturing more on the small business side, and with the will I say tax exemptions that they're getting, with the fact that we're seeing more support towards that sector, towards the small scale and medium enterprises. Expect growth within that sector to as well pick up, though there are bottlenecks like power issues, electricity, energy, that might slow down the prospects. But on a general level, when you aggregate, those are the positive signs that we're seeing for GDP.
How much disruption can we expect a pre-election year to bring into this mix?
So on an output level, the chances are that in a pre-election year, most things will be done, most policies, pronouncements, activities will be done to actually support growth. Remember, it's not a year to, while there might be disruptions primarily come from when election campaigns start. and that's on an inflation side, where we now see an inflow of more cash in the system, and how that tends to nudge money supply growth and then nudge inflation. But on an output level side, businesses, infrastructure development, all those things tend to actually pick up a lot more in a pre-election year, so that when the election year comes, there's support, right? So
there are things to boast about.
There are things to boast about.
But how much disruption can it bring to governance? For instance,
yes,
we have a level of insecurity in the country.
Yes.
Now, if our leaders, political leaders, focus on their careers and forget to give attention to dealing with that,
yes,
it can be a major disruption.
Of course.
So that's the aspects I'm trying to understand.
Okay, so thanks for the, will I say, context that you're coming from. I would say that there is typically more drive to somewhat solve, or at least cushion, the impact of such negative events on the economy. Remember, the political economy does not live in isolation, right? If the economy in itself, the macroeconomy, is not doing well, there's almost nothing to ride on for a political economy, right? So it does not live in isolation, does not exist in isolation. So if insecurity is a very big problem, if corruption is a very big problem, and those are the things that the political space, right, is envisioning that businesses, investors, consumers would rely on to vote or not to vote for them, chances are that there will be moves to somewhat douse the impact of those disruptions. So whether or not those moves will be sustained, I think that's where we actually even need to focus on that. Whatever is done in a pre-election year, right, to reduce the pain. Exactly.
Okay, but so the only fear is the inflation that might come with the cash that might come. Okay, all right, talking about cash now, looks like there's a widening gap between the official and the unofficial market for the Naira. I think as at yesterday, there was a difference of about 71 Naira. I hope we're not going back to the olden days.
No. I think that gap would begin to narrow as we get into the year. Remember that we're coming from the high peak, of the December period. There's a lot of demand for foreign exchange, both on the parallel side and even on the official side, but primarily even on the parallel side. Reason being that, most people needed that exchange, on the ground. A lot of public holidays, a lot of enjoyment, and so we saw a lot more demand. Exactly, a lot more demand on that side. So now that we're back to the cycle of the fiscal cycle, right, there is also still that typical lull in business activities in January. So we expect that as we get into the peak of economic activities heading into February, that gap would begin to narrow. And the fundamentals are also back in when you look at our reserve levels, the fact that businesses are going to continue their operations, and primarily that formalization in our exchange rate system is still very strong.
All right, thank you. I think that's a bit comforting, because I was getting scared, actually.
No need to be scared.
We can't go back to the olden days.
There's a lot more riding on this now.
Okay.
Even our forecast, even the IMF's forecast, is based off of the fact that we now have a more stable macroeconomic environment, and the FX.
What about commodities? Can we expect a continued decline, or we'll face our reality?
Well, I mean, I will say this, that the typical seasonality, that happens with our commodities market, we have not seen that trend dissipate, and expectation is going to continue. Prices would likely be more stable, but then once the planting season begins, prices are likely to increase for certain commodities. Tomato now is cheap. People are stockpiling now, buying a lot more now. The expectation is that very soon, once the planting season for tomatoes begin, prices would likely increase, right? So there's that cycle that's expected to continue, and like you rightly said, insecurity is still a very, very big issue impacting our commodities market. We're also seeing a lot more formalization and partnership, and I would say this is backward integration now that is happening. So we're seeing companies partner with farmers to ensure that, whatever products they can get locally, they're sourcing locally first before even now, demanding from the international market to, of course, encourage more production, encourage farmer
and also
income,
reduce their capital cost.
Exactly, reduce their capital cost.
All right, Dumebi, thank you so much for giving us those highlights. Manager, Financial Derivatives Company, Dumebi Oluwole, thank you for coming.
Thank you for having me.